Hey tubies, welcome back to our channel where we delve into the latest news and developments that shape our world. Today, we're diving deep into a fascinating revelation brought to us by Singaporean blogger Philip Ang. This revelation has ignited a fiery debate around Singapore's sovereign wealth fund, GIC, and its performance during the fiscal year 2023. As always, your engagement is invaluable to us, so remember to like, share, and subscribe to stay updated with insightful content like this. And don't forget to leave your thoughts and comments below, we can't wait to hear your take on this matter. Now, let's get right into it. The mainstream media outlets that we all know and trust, like Channel News Asia, Straits Times, and Mothership, have showered GIC with praise for its positive performance in the fiscal year 2023. They've reported record-high returns, resilient real returns above inflation, and an impressive annualized real return of 4.6%, the highest in 8 years. But wait, here's where things get intriguing. Philip Ang, a Singaporean blogger, has thrown a curveball into the mix with his alternative analysis. He suggests that these positive portrayals might be masking a different story altogether. Ang raises an eyebrow at GIC's unique choice of using a 20-year annualized real rate of return metric to measure its own performance. This, he argues, might actually help obscure losses by averaging them out with historical gains. It's a clever move if GIC has faced losses in certain years while still maintaining an appearance of profitability. Let's rewind a bit. In 2022, a whopping 75 billion Singapore dollars was transferred from the Monetary Authority of Singapore, MAS, to GIC. And that's not all, there was an earlier transfer of 185 billion Singapore dollar just 3 months prior. That's over 300 billion Singapore dollars, my friends, mainly invested in assets that some argue might have been overvalued. This hefty investment in potentially vulnerable assets sets the stage for potential losses that could have serious implications for GIC's overall performance. Now, let's zoom out and look at the global financial scenario in 2022. We saw a series of interest rate hikes by the US Federal Reserve, prompting other central banks to follow suit. As a result, global stock and bond markets took a hit, losing over $30 trillion. It's in this tumultuous environment that Ang estimates GIC, being the 7th largest sovereign wealth fund globally, could have shared in these losses, possibly around $69 billion, equivalent to approximately 95 billion Singapore dollars. But here's the kicker, Ang points out that GIC's sister company, Temasek, had a less than stellar performance in the same period, with a shareholder return of -5.1%, its worst in 7 years. This raises eyebrows and invites speculation about how GIC managed to achieve those 8-year high returns in such an environment. What about transparency, you ask? Ang draws a comparison with Norway's wealth fund, which reported a loss of $164 billion, and demonstrated a level of transparency that he believes GIC might be lacking. He also dives into GIC's diverse portfolio, including bonds, real estate, and private equities, all of which faced potential downturns due to various factors. To add a silver lining, the Singapore dollar's strength against global currencies in FY2023 might have offset some of GIC's losses. Nonetheless, Ang's analysis paints a contrasting picture to the mainstream media's portrayal of GIC's performance, prompting us to question the accuracy of reported returns and potential hidden losses. And there you have it, folks, a tale of two perspectives on GIC's performance. Now it's your turn. What do you make of this revelation? Do you think GIC's 20-year metric masks potential losses, or are these concerns overblown? Let us know in the comments below. And remember to hit that like button if you found this analysis eye-opening, share it with your friends to get their take, and make sure to subscribe so you never miss out on thought-provoking content like this. Thanks for tuning in, and until next time, stay informed and keep the conversation going.